President Donald Trump says he wants to put a limit on credit card interest rates. Trump says credit card companies are ripping off the American public and is calling for a one-year cap on interest rates at 10% beginning as soon as January 20th. Now, here to break this down, editor-in-chief at Investopedia, Caleb Silver. Caleb, thanks for joining me. How might this cap affect credit card users and their banks?
Well, if that cap was at 10%, that would almost cut in half what APRs are on average for credit cards right now. They're somewhere between 19.5% and 21.5% on average. But if you have poor credit, you may be paying as much as 30%. So that would lower the interest payments that borrowers are making on a month in, month out basis just to service their credit card debt. That could bring down costs a lot for families, especially when you consider the fact that the average credit card debt is around $7,000 per borrower right now. And the average borrower is paying somewhere between $900 and $1,100 a year in interest payments. If that's cut in half, that goes down to $500 or $600, and that's some serious savings.
Now, all of this comes as Americans struggle with debt. Could this also affect how many people can qualify for a credit card?
Yeah, and you could see the credit card industry not liking this news at all if this were to go through, either through executive action or through legislation. So what would they do? They would tighten lending standards, and that would push borrowers who don't have good credit, who they don't want to lend to, out to other services like buy now, pay later, or payday loans, which could be a little bit more dangerous. So the credit card industry and the banking association, the big lobby that backs this industry, does not want this to happen at all. Yet this is a campaign promise that Trump made while he was on the campaign tour coming in to office this year, and he'd like this to go into place, as you said, by January 20th, a year from the inauguration.
All right, I want to switch gears a little bit. Mortgage rates, they've now dropped to the lowest level in nearly 3 years. Trump ordered officials to begin buying $200 billion worth of mortgage bonds in his latest push to lower costs. Now, do you think this could help push rates even lower?
Yeah, it already has. If you look at the action that happened on Friday, rates went to the lowest level that we've seen in 3 years. Why? Because he wants to authorize Fannie Mae, which was the biggest backer of home loans, to buy mortgage-backed securities. What does that mean? Taking supply off the market in terms of that debt and making it cheaper to borrow. And that is what's pushing rates down. So $200 billion is not a lot in the grand scheme of the housing market, yet it is another incremental step that could bring down mortgage rates just in time as the Federal Reserve is set to lower interest rates at least once more in 2026, maybe twice.
All right, but let's look at the full picture here, okay? There's currently an affordability crisis. We know this. But do these lower rates potentially come with some kind of caveat that we're not really seeing right now?
No, just more competition because so many people have been on the sidelines waiting to get into the housing market or sell their homes to get into another home. So it could stir competition in the housing market, could get buyers off the sidelines who've been afraid of 6% plus 30-year fixed mortgages. So it could actually increase prices. It could have an inflationary effect on the housing market, but housing prices are already pretty expensive right now. If this brings down rates, it could open up the housing market. That could generate some economic activity, keep the economy humming in 2026. That move, plus this potential move on capping credit card APRs, those could be very big deals in terms of the promises this administration is making on affordability. Those actually move the needle a little bit. A lot of the other things don't. These might actually help.
All right, Caleb Silver, thanks a lot.